Well, hey there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, January 7th. I am your host, Dave Keller, coming to you from a kind of beautiful Tampa, Florida. Great to be down here in the Sunshine State. If you've ever been to the Pacific Northwest, you know the Seattle area has very little sunshine between November and April. So as a Seattleite, it is awesome to come to the southeast corner of the country, enjoy some sunshine. I've walked around a number of times the downtown area, just taking it in and enjoying the temperate weather. So enjoying it. Hope you guys are all staying warm, doing well wherever you're at. We're down here for the CMT Midwinter Retreat, which kicks off this evening, but did want to take time now after the market closed to share with you some observations on the current market conditions. As always, we'll go through 3 steps, starting with a market recap, looking at the major averages and asset classes. We'll look at the heat map, a lot of red today as the S&P gave up some of its early gains to rotate more to the downside, finished in the red, as did the NASDAQ. And we'll finish off looking at some charts that I've hand-selected through the course of the day to highlight for all of you. As always, please keep your questions coming in the comments section of our YouTube channel. We appreciate them so much. Just this week, we've already received some really thoughtful questions. We're planning an all-mailbag episode on Friday. We'd love to answer one of your questions on the show. In the meantime, let's look at the market, shall we? So the S&P 500 down 1/3%. So got up as high as 69.65 midday. It's right around lunchtime. We had another kind of strong, morning session, but the afternoon fairly weak. Sell-off started right after 12 o'clock noon Eastern time, continued essentially into the close. The S&P finished just above 69.20. Again, that's down about 1/3%. The NASDAQ, apologies, I meant to, the NASDAQ did not finish lower. I was thinking of the downward trend. It did finish just above the close from Tuesday, finished up just slightly, about 0.2%. This is one of those where if the close had been extended another 20 minutes, I feel like the NASDAQ would have been down for the day. It was sort of hanging in there until the close. The Dow is down almost 1% to lead the way lower. Mid caps, small caps, all down about as much as the Dow, less than 1%. Volatility remains fairly low here, right? The VIX did go up to 15.4, but at a 15 handle, this is still fairly low volatility. So basically the options market's telling you not big day-to-day movements are expected with the S&P 500, kind of days like today where you finish 1/3% down, 1/3% up. That's what a VIX down in this range generally implies, or at least that's what the options market is currently pricing in. Again, what I love to think about in this kind of environment is to totally simplify the role. 2 things. Number 1, what's the trend? And number 2, what would tell me the trend is changing? And I feel like that is a simple 2-step process you should do with any chart you're ever looking at through the rest of your investing career. Look at the chart, think, what is the trend? What do I think is coming next? And number 2, what would tell me that trend is different, right? And I think that's important. So, on this front page, what's the trend? The trend is still up, right? The S&P was slightly down today, but we're off, very, very close to new all-time highs. We're above 6,900, which was our kind of green light level. If you think back to the traffic light technique we talked about toward the end of that last year before the holidays. So what you look for, besides a breakdown in price, would be an increase in volatility, right? The VIX going above 20, widening credit spreads, the high yield option adjusted spread, which is a chart we track pretty regularly every week, would need to widen out, indicating that bond investors are getting nervous. Neither of those things are happening just yet. So we're still in a pretty decent space. We're still making higher highs and higher lows. I tell people, it's not about predicting the future. It's not about, pinpointing the top. I don't think that's the game. The game is just recognizing when the trend shifts. I find investors get into trouble not because they can't predict the future. It's not that your crystal ball is broken. It says they don't have good routines. They don't just recognize when the trends change, right? And then, recognize that Netflix is no longer in an uptrend, right? You hold Netflix way longer, even though the uptrend is no longer in place. Hopefully this show helps inform you and educate you, empower you to recognize some of those trend shifts and make better decisions down the road. But we digress. Continuing on here, looking at interest rates. Generally, the yield curve lower today. The 10-year yield finished below 4.2%. We'll call it 4.14. The long bond yield's right around 4.8%. 5-year point around 3.7%. The TLT, which is a bond ETF that we track, is up about 0.6%. So stocks down, bonds up was a general way to think about this day. The dollar index slightly higher. You can see the UUP finished up just a couple pennies, not too much. Precious metals managed to pound out a down day. Silver has had an incredible run already in the beginning of, less than 5 trading days in January, and silver is already ripping to the upside. Did give back some of those gains today after a new high yesterday, down 3.7%. Copper prices, crude oil prices, all down as well. Gold down about 1% on the GLD. So sort of a risk off, again, 1-day move on some of those precious metals. I have to tell you, those charts still look quite strong. Certainly an increase in volatility in the precious metal space, but still making higher highs and higher lows. Cryptocurrencies going kind of risk off here. That started overnight Eastern time, but continued lower through the course of the equity trading session. Interesting, today Bitcoin sort of served as a bit of a leading indicator, kind of showing you maybe the initial rally in stocks did not match the risk off configuration we've seen in the last 24 hours with Bitcoin. Bitcoin's currently sitting just above 91,000. Coming off of a peak yesterday around 94,000 and change. All of the top 10 coins here on the stock charts platform in the reds. We did not quite get above that 94, 95K range, which was sort of my general sign to get back into Bitcoin after unwinding some positions. I'm still waiting. Looking at the 11 S&P sectors, here's where things kind of got uglier through the course of the day. Earlier in the day, a little more mixed. As the day went on, less and less of the S&P sectors were in the green. You can see going into the close, it was only healthcare that actually managed to be up for the day. The XLV was up 1%. Everything else was down. The next two sectors were basically flat. I mean, just slightly lower for the XLK. Technology and the XLY, consumer discretionary. So the growth sectors did okay, but healthcare did the best. On the downside, utilities really breaking down 2.5% lower on the XLU. The relative performance of the utilities sector made a new 52-week low today. I grabbed a chart to show you that along with some of the other defensive sectors a little later in the show. Industrials down 1.9%. Materials down 1.7%. So materials was, I believe, if I remember right, the top sector yesterday. So a bit of a mean reversion on some of the value sectors like industrials, materials, financials, which have been doing quite well recently. To start off 2026, these have been the strongest sectors on a relative basis. Not a great day, giving back some of those previous gains so far in January. Looking at the breadth conditions, finally a down breadth day. The breadth has been pretty consistently good in January so far. Today, the first big down day on the S&P, on the New York Composite Index, about a 2-to-1 ratio, 64% down to 34% up. On the S&P 500, almost a 4-to-1 ratio, 77% down, only 23% up. So definitely a distribution in terms of breadth. It's very interesting. What we've talked about on the shows so far this week is that general move away from growth into value, right? And what we've seen so far in 2026, a lot of the FANG stocks, right, like NVIDIA, like Netflix, like Apple breaking down here, not particularly strong, even though the S&P is testing new all-time highs. And what was working were things like financials, industrials. What we saw today is a return back to some of the growthy sectors. You're going to see stocks like Alphabet back up toward new all-time highs. Alphabet's been lagging a bit in January. Pharmaceutical names in the healthcare sector like Eli Lilly breaking out again or rotating back toward their previous high. So sort of a mean reversion back to the growth and healthcare trade, which was doing well earlier. All right, looking at the Magnificent Seven and Friends, very much a mixed day. You can see on the top, Alphabet, as I mentioned, the best performer here, up about 2.5%. Microsoft managing to hold steady after breaking down going into this week, up 1.1%. NVIDIA up about the same, up 1%. On the downside, Meta continuing to underwhelm here in January, down another 1.8%. Apple following through after yesterday's breakdown. I don't think that's a good thing. I think I grabbed that chart. Did I? I believe I did. I did. Good. Apple is one I want to highlight just as a breakout name, a breakdown name there. And continuing what we talked about on yesterday's show, broke down below our line in the sand. And so you always look for follow through. You look at the next day to see if there's further deterioration, which would tell you it wasn't just a whipsaw one day thing. It's probably more of a significant breakdown. I think today we got that downside validation. Tells me it's not a great chart here, and that's looking at Apple. As a reminder, appreciate you so much checking out the comments section, dropping any questions that come up through the course of the show. We'll do an all mailbag episode on Friday, and we'd love to answer one of your questions there. This week, I'm sort of planning out the first 6 months of the year the best I can. There's a lot of moving parts with everything with travel and stuff, but I'm trying to get a sense of, sort of my content calendar, what kind of things I'm going to be putting out when and how. I am thinking about the live component of the show. I've gotten some feedback on the live component. I appreciate your feedback again. As always, no need to use all caps. I get it. I hear you. I'm listening. I'm reading everything. So I appreciate you sharing some thoughts. Any feedback's welcome. But definitely, I appreciate that so many of you love asking live questions, thinking about how to incorporate that in the show, thinking about different ways that I can get content out to you, and certainly want to celebrate that. We are planning a market outlook next week. This is my 2026 market outlook. It is going to be reserved for market misbehavior premium members. I hope to be able to announce the specifics for you tomorrow. So you're welcome to join in, but I will tell you right now, if you want to tune into my 2026 market outlook, where we'll talk about seasonal tendencies, we'll talk about key charts to watch, we'll talk about expectations for the first 6 months to the year, and what sort of themes we see as emerging to set the table for a fantastic meal we can eat together in the first 6 months of 2026. Please consider being a Market Misbehavior Premium member. You get access to virtual courses. You get access to our member community where you can ask questions anytime you want. And you also get all of our member-only reports, like our monthly chart review, our weekly flight plan, and our annual market outlook, where we will be hosting as a live stream next week. So if you love live questions and you want to ask them, that is one way to be able to ask live questions. And I, with my premium members, I try to answer every question that comes in. That's one of the benefits of being a premium member. You can find more info at marketmisbehavior.com/premium. Make sure you use the code YouTube when you check out for 30% off your first 12 months on any plan. Would love to have you join me. You can participate in the live market outlook and among other awesome things for members. All right, let's continue looking at the market carpet here. A lot of red. And if you looked at the market carpet through the course of the day today, if you looked at a heat map like this on any platform, it looked a lot less red earlier in the day. Earlier in the day, a lot more green. Through the course of the day, a lot more red, particularly in the right half of this visualization, which is where sort of the value sectors and a lot of the defensive sectors are. You've got the three big growthy sectors over here: technology, communication services, and consumer discretionary. And again, I was immediately drawn to the fact that Alphabet was up. NVIDIA, which has been lagging, was up. Microsoft, which has been not a particularly strong chart, was up. So some of those names that have been struggling a bit, rotating higher. Some of the, healthcare, which was actually down quite a bit yesterday, if I remember right, bouncing higher. Eli Lilly threatening a new all-time closing high. On top of that, things like financials, industrials, real estate, energy, materials, all in the red. But also over here, we had the big hard drive names, right? Western Dig, WDC, Seagate Technologies, STX. Those were both down 6 to 9% today. This is after having huge up days yesterday. So again, very much a mean reversion in some of those leadership charts between technology, communication services, healthcare as well. But I would say on top of that, in terms of the heat map, the red that I'm seeing across the board here over on the right side, and there's just so many charts to kind of think about. And I think the challenge for this market, to be honest with you, charts like Starbucks, I think are great to talk about, right? If you look at mid-December, Starbucks looks like a particularly compelling chart. And one of the scans that I run regularly are stocks making new 3-month highs. And Starbucks popped up on my screen on this day right here, third week in December, because it closed above the 200-day moving average, because the price broke above resistance. And all of a sudden, this looks like a pretty significant breakout. Seems like a good opportunity. That breakout failed, right? We had a 1-day move higher. The next day, we have a bearish inside day, or what's called a harami, a bearish harami pattern, if you're more of a candlestick person. Both of those are short-term reversal candles. And as we can see, the next couple of days were lower. From there, we bounce off of support. We rotate higher yesterday to close again above the 200-day moving average for the second time in the last month. But today we go back down. We have another bearish inside day, or what's called a bearish Harami pattern. Suggests that the next 1 to 3 bars, more likely lower, suggests that this recent breakout above the 200-day is not sustainable. So if you're optimistic about this market, you're probably all bulled up because you've seen some of these breakouts that we've observed in the last month. And I don't blame you. It's been pretty impressive. And if those breakouts follow through, I'd say that's incredibly bullish. Breadth indicators have reflected the fact that a lot of things are starting to work. Charts like Starbucks show me it's not everything, right? Not everything is really participating in the upside. I would say a chart like this is still kind of neutral, right? Given the distribution, short-term distribution patterns we've seen on the attempt to break above a key moving average. So still kind of a questionable moment for some of those charts. All right, we finish off the show looking at some charts together. These are all charts I've hand selected through the course of the day today. Love to talk through each of them with you here. Here is the S&P 500 again with our what we're calling our traffic light technique. This is the idea of looking at a range, right? Looking at a key level of resistance, a key level of support. We set up this range back in December. Beginning of December, end of November, kind of thinking about, all right, here's the range in the S&P. There's the previous all-time high from the end of October. There's the low, the swing low around 65.50 just before Thanksgiving. There's our range. So anything above that previous all-time high, I think of that as pretty bullish. So over 6,900 is pretty good. We've had a couple attempts to get above that high, and we've failed each one of these times now to really follow through to the upside. The S&P having a bit of a bearish Harami pattern here as well. We haven't gotten down to the red light area, which would be below 65.50, but we did talk about this trend line, this short-term trend line on yesterday's show, connecting the lows from November and December, connecting that to that candle there, which I think is the first trading day of January. We still are above that short-term trend line. So break back below 6,900, we're back in a yellow light. That would take us below that trend line support most likely. Until we get below 65.50, I would say this is still a pretty constructive chart. However, the momentum is dead neutral. The RSI is sticking between 40 and 60. I'd say sideways momentum reading. Lots of stocks making new 52-week highs. This is on yesterday's session, about 64 names out of the S&P 500. So you call that 13% of the S&P made a new 52-week high on yesterday's close. Not bad, right? That's actually pretty impressive, right? So, new highs are bullish, right? A bullish market traditionally has an expansion to new highs, right? As the S&P and the NASDAQ are pushing to new all-time highs, which they're very close to doing again this week. More and more stocks should be supporting that uptrend. And as the leading names go higher, other names start participating, more and more stocks making new 52-week highs. That's a pretty good reading. That's actually the most new highs we've seen on the S&P going back to February of 2025. So it's been a while since we've had this many new highs, 13% of the S&P. So impressive, right? It's a good number. Let's want to see more of that. I think the bull case from here most likely needs to see an expansion in new highs. I do want to make a comment here. I've seen some, questions out there about divergences. I'm going to take a big step back here and look a little bit more longer term. One of the things I'm going to talk about in my presentation here to the CMT Midwinter Retreat tomorrow is talking about how mindful investors consider multiple time frames. Right? You think about short term versus long term. You think about the relationship between the flickering ticks, the daily movements of the market, with the long term, more of the cyclical and secular shifts that we can measure using weekly and even monthly charts. So in that vein, we're looking at a weekly chart of the S&P 500, because if you look at the weekly chart, you're going to find, whether you're looking at RSI, which is the bottom panel, or whether you're looking at MACD or PPO, which is that next panel up, the S&P made a new all-time high in January, but that's on weaker PPO levels. That's on weaker momentum, weaker RSI levels. We have this bearish divergence of the market going higher with weaker readings in these key indicators. Now, I've highlighted with these red lines previous times where we've had a similar divergence, higher highs in price that are not supported by an uptrend in those key indicators. Now, has that divergence always led to a major peak? Not necessarily. There are times when there's been a divergence, hasn't been that bad, right? And for example, mid 2024, we had a pretty big divergence here, right? Where the market's making new highs on weaker momentums. Another 6 months, 3 to 6 months of an uptrend before the February 2025 high. So now there are others where there was a divergence and then there was a major top soon after, right? We had a big momentum divergence in February of 2020. We had another one in December of 2021. So sometimes it works quite well. What I would argue is the divergence is not as much the most important signal to watch. It's the breakdown that would happen after. The way that you differentiate between the divergences that worked really well and the divergences that were kind of false signals is what happens afterwards. And those breakdowns, we had the market move lower soon after that divergence, recognizing that the divergence was in fact acknowledging the weaker momentum, that the market is actually going lower as you might expect. And so I think the breakdown in price is the real signal. I think too many people see a divergence and they start selling immediately, thinking, "All right, there's a divergence. I'm going to be early, and I'm just going to sell now, and then I won't miss the top." But if the market keeps grinding higher, the momentum can always improve, right? Which is what we've seen in previous times, right? In 2024, the market eventually resolved higher and the momentum started to improve again. So it was less a divergence, or the divergence just lasted way longer than you might want. So the trend is the most important thing to watch. The breakdown in trend in early 2025, the breakdown in trend in early 2022, the breakdown in trend in early 2020, that's the real signal. And so you have to be patient, I would argue, with major tops like this. So the divergences like this, I think of it like the Hindenburg omen, super important to note. I have learned not to ignore those signals. They are important early warning systems, but think of them like a tornado siren. If you have lived in the Midwest, or you know what I'm talking about, a tornado siren is something that it goes off to tell you conditions are ripe for something really bad to happen with a tornado in your local area. It does not guarantee that a tornado is going to come down your street and cause horrible damage. It tells you there's an elevated chance, way more than normal, something bad could happen. When that tornado siren goes off, you are trained to go down to your basement, not to think, do I really think a tornado is going to come down the street? It's probably fine. That's when really bad things happen. That's when you can be in a position of danger. So similar with tornado sirens, if the tornado siren's going off, I think it's good to be ready, right? Be ready to go down to the basement. Look for the breakdown in price. That's the tornado coming down our street. Haven't seen that yet on the weekly chart of the S&P for sure. All right, defensive sectors. Wanted to highlight this because utilities were down 2.5%, I think I said, for the XLU. So I think it's important to think about how the relative performance has really deteriorated. If you look at the last 3 months, from mid-October now to early December, utilities have been underperforming. Now, there's a bit of a sideways move in December going into the end of the year, which made me think, all right, maybe we're starting to see some stabilization. This week, however, the utility sector once again underperforming. We're making a new 52-week low in the relative performance of utilities. Skip healthcare, go down to consumer staples, which you can see is very close to making a new 3-month low in relative strength. Look at the real estate sector, very close to making a new 3-month low in relative strength. The only outlier here is healthcare, which is starting to look more and more like it's diverging from the other defensive sectors. Now, that's happened before, right? Sometimes healthcare is more of an offensive, other times more of a defensive sector. Generally, there tends to be a pretty decent correlation in the relative performance of these 4 defensive sectors. And if you look at the 4 data series, you can see that generally plays out. This is one of those times, though, however, where healthcare is actually doing a lot better than the other defensive sectors. Something important to watch. And if you use the RRG, a visualization created by Julius DeKempener and found on Stock Charts and Optima and a number of other leading charting platforms, great thing to watch to look for that continued rotation into healthcare and maybe away from those defensive sectors. How bearish do you want to be when the defensive sectors are underperforming? And the answer is not much, right? That's one of those red flags I would look at, similar to the VIX and other things. All right, let's finish off looking at some individual stocks. Intel made a new intraday all-time high. Didn't quite get there on a closing basis, but it did trade above $44 a share for the first time. It closed up about 6.5%, very close to the overbought reading. Kind of a really choppy, volatile chart of Intel. I feel like the VIX for Intel particularly would be pretty high right about now because we've had these big, certainly cyclical or tactical swings about 1 month at a time. Now, these last couple times we've gotten up around these levels, and that's kind of been it. So I think, in this case, I would probably look at like an hourly chart, use an RSI on the hourly chart to try and pinpoint some of those short-term reversals. But for now, Intel retesting those previous highs. A close above that December peak would be pretty encouraging. Alphabet, as I mentioned, the best out of the Magnificent Seven stocks today, and arguably at this point, probably the best chart of the bunch, right? We're back above the 21-day EMA. Not many of the Magnificent Seven stocks can make a similar claim, up 2.4%. This after being kind of sideways for the last couple weeks of 2025. Nice follow through to the upside, not quite to a new all-time high. We need to get above 330, but setting up potentially for that breakout. While Alphabet is breaking out, Apple breaking down. We highlighted on yesterday's show, Apple breaking below our line in the sand around 265. What we talked about on yesterday's show was looking for follow through. The next day, do you see further deterioration? I think we got that today. What today's action tells me is that yesterday most likely not a fluke. While we could certainly get a bounce, a counter trend bounce off of an oversold condition, this tells me now that we're making lower highs and lower lows, think of the primary trend in Apple as lower until proven otherwise, or as we like to say, guilty until proven innocent. While Apple's been breaking down, Vertex Pharmaceuticals, other biotech names have done quite well. This is sort of the pharma biotech alphabet day, I guess is how I would describe it. Vertex making a new 3-month high. It popped up on my radar for that, up 3.4% today. Did slightly get into the overbought region. But again, this is a chart that's been making a pretty consistent pattern of higher highs and higher lows. I love the break above the 200-day, the retest, and then the follow through to the upside. That's pretty encouraging breakout. Caterpillar and other industrial names, which we've highlighted in the last couple months, stalling out now. Today, after yesterday testing the previous all-time high from December, tried to get higher today, but ended up finishing more toward the lows of the day, down about 4.3%. Still not horrible, but I would say at this point, a potential double top pattern. The 50-day moving average is a good place to look for potential support. We've had a number of pullbacks to that level going back for the last 12 months. Last chart, Wynn Resorts, right? In the consumer discretionary sector, a lot of things kind of not going up today. Wynn and other gambling stocks struggled. Wynn was down 3.5% today. And again, when I talk about the conditions in this market, I showed you Starbucks earlier. I think Wynn is another one of those charts, right? If the market's really bullish here and people are just spending money and the economy's good, I would expect Wynn to be looking a lot better than this, right? Not that gambling stocks are the most perfect bellwether, but this is a travel and tourism name. This is a Las Vegas name, sort of a proxy for how much are people spending money. And, it's kind of for entertainment. A true discretionary kind of thing. Stocks going down, stocks threatening a new 3-month low. We're back to the lower end of this range. So again, think about that stoplight technique we talked about with the S&P. Green light for me is over like 133 to 135. Red light is below 112 to 115, which means we're right in the middle of the yellow light area, but we're getting really close to the red light. 200-day moving average is not too far below current levels. Fibonacci retracements, other things can be helpful here as well. But I would say just thinking about this range is important. The fact that this could be just a classic double topping pattern. Charts like this are not looking strong. The RSI is pushing below 40. This is a stock more in a sideways trend at best, and at worst, setting up for a potential breakdown. Important to watch the lines in the sand on charts like Wynn. Folks, that'll do it for today. I want to thank you so much, as always, for following me, for watching my content, for sharing comments, for asking questions, for telling someone else that that you think could benefit from my content, where to find me. It's been a joy to do this show to recap the market action in 2025. I am thrilled to continue to do it here in 2026, doing a lot of thinking about what all content I'm putting on YouTube, on my podcast, on other places. I appreciate you following me here and on social media, where I'll certainly keep you updated. But for now, I'll say thanks so much for watching. I'm Dave Keller with Market Misbehavior, wishing you a wonderful evening. And remember, it's always a good time to own good charts. Have a good night, folks.